Hey guys, I'm planning to start a series on financial instruments. Why I said a series is because financial instruments is a very vast topic. There will be a lot of concepts that you will have to learn before appearing for any IFRS exam. So today I'm going to start with only the basics of financial instruments. What is the definition of a financial asset and definition of a financial liability? The definition of financial liability says that anything where you have to make a payment to someone in cash. Now, when I say in cash, it means whether bank transfer or anything. So, whenever you have to make a payment to someone, when it is your payable, it becomes a financial liability because you have an obligation to deliver cash to someone. Now, that is one definition of financial liability. Another case can be when you are exchanging any asset with someone. When you are in an unfavorable position, that also becomes a financial liability for you. Or in a derivative scenario where you are at a loss, that also becomes a financial liability for you. This is the definition of a financial liability. The definition of financial asset is opposite of this. Any condition where you are supposed to receive cash from someone or where you are in a favorable position when the assets are being exchanged, or in a derivative contract, there is a receivable which is going to come to you. These are all cases of financial asset. Why knowing the definition of financial asset and financial liability is important is because in all the IFRS exams, we have noticed that one question which is quite often asked is what is the difference between equity and financial liability? So I'm going to touch base upon what is the difference between the two. In equity, that is equity shares of your company which you have issued to someone, because you have issued to someone, it should go ideally under the liability side. But that does not go as a financial liability. Why equity is not classified as a financial liability and only a liability is because the core definition of financial liability requires you that you need to be obliged to pay cash to someone. That is, you have to pay cash to someone on a fixed date or at some point in future. That is the definition of a financial liability, where you are obligated to pay cash to someone at some point in future. In case of equity, you are not obliged to pay any cash. Dividends, which are paid in case of equity, the issuer is not obligated to pay dividend. It is at the discretion of the company or the issuer to pay dividends or not. So you see how both of them are different. Under equity, there is no obligation to deliver cash, whereas under financial liability, you have to deliver cash via a repayment of principal or an interest. This is a very common scenario which is asked in financial instruments in IFRS exams, where they will ask you whether a particular issue should be classified as a financial liability or as an equity. Knowing the definition of the two will certainly help you in distinguishing the same. I hope I was able to clear this definition for you. Please let me know in the comment section if you want me to elaborate more on this topic. And please comment if you want me to cover any specific topic.